Do you ever feel overwhelmed by multi-time frame analysis, seeing one thing on the 5-minute chart, but something completely different on the hourly? You're not alone. Most traders get lost in conflicting signals and struggle to make sense of it all. In this video, I'll break down a simple 2-time frame strategy that clears the confusion and reveals exactly how to align your trades with the big players' moves. Now, let's break down why top-down analysis is essential for your trading success. One of the biggest benefits of top-down analysis is that it helps you align with smart money signals and avoid fake zones that could lead to losses. Here's a great example. Let's say you're analyzing the US dollar Canadian dollar on the 5-minute chart. You spot what looks like a strong supply zone, and as the market approaches, there's a clear rejection, making it seem like the price is set to move down. It might look like a great short setup at first glance. But before jumping in, let's zoom out to the hourly chart. Here we see something important. A key support level was broken, but then price quickly reclaimed it, closing back above. This pattern is what we call a liquidity sweep, a classic smart money move designed to trap sellers by breaking below a support level, triggering stop losses, and then reversing upwards. This signal suggests that the bigger players are pushing the price up, not down. Now, if we return to the 5-minute chart with this higher time frame context in mind, we recognize that the supply zone is likely a fake setup, part of the trap set by smart money. By ignoring this short trade, you avoid being caught in a reversal that would have gone against you. Without top-down analysis, you might have taken the short position and been blindsided when the market moved up. This approach helps you trade in line with the bigger players and avoid the traps that can otherwise lead to quick losses. Top-down analysis keeps you aligned with the market structure. By starting with higher time frames, you catch the key levels and trends that aren't visible on lower charts, helping you avoid trades that clash with the market's dominant direction. Here's a great example of why top-down analysis is crucial. Let's say you spot a bearish setup on the hourly New Zealand dollar US dollar chart, a strong breakout, tempting you to go short. But let's take a step back and check the daily time frame. On the daily, we see a different story. The market has been trending up, then consolidating, forming a clear demand zone. In fact, the price was recently rejected from this zone, suggesting an upward move is likely. Now that we've marked this zone, let's return to the hourly chart. That breakout may still look appealing, but now we know it's sitting within a demand zone on the higher time frame. This means the breakout is probably just a pullback, and taking a short trade here could put you against the bigger trend. Without this top-down analysis, you might have jumped in and been caught off guard when the market reversed. By using the full picture, you filter out trades that go against the dominant structure, keeping you aligned with the market. Top-down analysis helps us avoid low reward to risk trades and spot the end of short-term trends. Let's take a look at the Canadian dollar Swiss franc 5-minute chart. Here we see the market trending up strongly, breaking through resistance levels that then turn into support. It's tempting to think this upward trend will continue, so we might feel like jumping in for a buy trade. But let's check the 1-hour chart before we commit. On the hourly, the market is indeed in an uptrend, but it's approaching a major resistance level and a strong supply zone. These higher time frame levels act as potential reversal points where price could turn down sharply. Now, let's return to the 5-minute chart with this new insight. With that hourly resistance and supply zone in mind, it becomes clear that entering a buy trade here might be risky. Our target would logically be the supply zone, but that would mean a low reward to risk ratio since the target is close by. This setup doesn't align with our goal of high reward to risk trades, so it's best to avoid this one. And look what happens when price reaches that supply zone. The market reverses just as expected. Without top-down analysis, we might have entered this trade and been caught off guard by the reversal. By analyzing both time frames, we protect ourselves from setups that look good on the surface, but don't hold up when we see the bigger picture. Now that we understand why top-down analysis is essential, let's dive into how to actually conduct it step by step. First, let's talk about a common approach that I call the crowd technique, because it's the method most traders use. This approach involves multiple time frames, but it often leads to more confusion than clarity. I'll show you why, and then we'll dive into a more effective, streamlined method for top-down analysis. The crowd technique works like this. First, traders start with the weekly chart to get a big picture view. They mark key support and resistance levels, thinking this will help them understand the overall market direction. Next, they move down to the daily chart to refine those key levels and look for possible trade setups. Here, they try to narrow down opportunities by focusing on how price moves around those weekly levels. Finally, they switch to a lower time frame, like the 5-minute or 15-minute chart, to find the perfect entry point. At this stage, they're looking for specific patterns or candlestick signals to time their trade. While this method can seem thorough, it's usually overwhelming. The crowd technique often results in charts cluttered with too many levels and zones from different time frames, making it hard to stay focused and increasing the chances of hesitation or confusion. By trying to analyze everything, traders can end up missing the bigger picture or getting lost in unnecessary details. In my experience, the best top-down analysis approach is what I call the dynamic top-down analysis. Unlike the crowd technique, which can feel overwhelming with multiple layers, dynamic top-down analysis uses just 2 time frames. This approach keeps your chart clear, helps you focus on the essentials, and allows you to make decisions based on key levels without unnecessary noise. Here's how it works. With dynamic top-down analysis, you only need 2 time frames to keep your trading focused and effective. Start with a higher time frame to find the most important levels in the market. This includes key support and resistance levels, supply and demand zones, and order blocks, all areas where price is likely to react. These levels give you a roadmap and help you stay aligned with the overall market direction. Once you've marked key levels on the higher time frame, switch to your lower time frame to look for specific trade setups and entries. This is where you'll identify setups that align with the levels you marked, filtering out unnecessary noise and focusing on entries that match the bigger picture. Here's how to choose your time frames. If you're trading on the 5-minute or 15-minute chart, use the hourly chart as your higher time frame. If you're trading on the hourly chart, use the daily as your higher time frame. If you're trading on the 4-hour chart, use the weekly as your higher time frame. With this simple 2-step method, you're able to pinpoint entry opportunities that align with the key levels from the higher time frame, creating a focused, clear, and dynamic trading approach. Let me walk you through a powerful example of how dynamic top-down analysis can help us validate a trade setup on the Euro-Canadian dollar 5-minute chart. We start on the 5-minute chart, where we spot a potential bullish order block. Several factors confirm this order block as valid. First, we have a break of structure, where the price has broken above a recent level, signaling upward momentum. Next, there's a fair value gap, a space between recent candles which suggests an area where the price might return before continuing higher. Finally, this is an unmitigated order block, meaning it hasn't been retested yet, so it's still fresh and holds potential. So we draw our order block and wait for the price to pull back into the fair value gap and retest the order block. As anticipated, price returns to this area and shows a slight rejection, giving us a solid entry signal. Now that we spot our entry on the lower time frame, we switch to the hourly time frame to see the bigger picture. On the hourly chart, we find a few key details. First, there's a major resistance level just above, along with a strong supply zone. Recently, the market broke through this resistance and moved past the supply zone, which suggests there could be some upside momentum.